Despite what some news outlets would have you believe, China is losing the tariff war. After years of dominating global trade and relying on American consumers to drive its manufacturing economy, the tide is turning. What began as a bold political move in 2018 transformed into a powerful economic shift. The United States launched a full-scale tariff offensive, and despite all the retaliation and resistance, China found itself trapped in a game it can't win. Today, nearly 39% of what China manufactures is sold to the US. That's not just a trade relationship, that's dependency. As tariffs climb above 100% for key goods, that dependency starts to collapse. American demand shrinks, and Chinese factories feel the pain. Despite multiple opportunities to negotiate, China has refused to return to the table. But with exports falling, supply chains shifting, and political pressure mounting at home, that decision looks less like strength and more like denial. The numbers speak for themselves. As tariffs rise, US imports from China drop 25%, wiping out over $80 billion in trade. At the same time, countries like Vietnam, Mexico, and India step in to fill the gap. Corporations move quickly to relocate production. Once supply chains move, they rarely come back. This isn't just a slowdown in trade, it's a structural exit from China's export engine. There's talk about China using its US debt holdings as leverage. It holds around $760 billion in Treasuries, enough to get headlines, but not enough to change the outcome. If China sells those bonds, the dollar weakens, but that sends the yuan higher, making Chinese exports even less competitive. For a country fighting to keep factories open and unemployment down, that's a lose-lose move. It's not retaliation, it's self-sabotage. Meanwhile, the United States adapts. American consumers remain the buyers of last resort. If they stop spending on Chinese goods, factories in China stop running. If those factories shut down, millions of Chinese workers lose their jobs, and political unrest follows. That's not a threat, it's reality. By 2023, over 70% of US manufacturers began actively moving production out of China. This is no longer a warning. It's a massive realignment of global manufacturing. Not everyone in the US will escape untouched, however. Importers and small businesses face higher costs. Consumers pay more at checkout. But what they gain is bigger: a stronger, more diversified supply chain, more domestic production, and a trade position less dependent on an authoritarian regime. China, on the other hand, sees its GDP growth hit record lows, its tech sector cut off from the future, and its export model cracking under pressure. This isn't just a tariff war, it's a shift in the global order. China rose by offering cheap labor, lax regulations, and committing theft of intellectual property. But now, the West pushes back. Technology bans, capital flight, consumer shifts. The model that builds modern China is breaking, and the US finally has the leverage to reset the rules. The tariff war is only the beginning. In the next episode of You Are Here, we break down how tariffs are just a small part of a bigger contest for global dominance, and what comes next for global markets. Subscribe now. The world is shifting fast, and you deserve to understand exactly where you are.